What's the big deal about policy loans? I'm going to suggest that policy loans are the most flexible loan that you can have. However, a lot of people have questions about why this is, what's the big deal, how do they actually work. Denise Pavier has an example of this and how they work. She's going to explain the whole thing to you in this quick video today. Let's jump in and then I'll be back. Take it away, Denise.
Thanks, Steve. Denise Pavier, INE Pro Guiding Coach. Many of my clients are very active in their high cash value policies. They fund them generously and they take advantage of their liquidity by using their cash value for purchases or business expenses or whatever it is they're needing. And the way they do this is by taking a loan on their policy. And we've talked about loans in many of our videos. However, today I want to address a common question that many policyholders have. What is the difference between paying the annual interest on my loan or not? What effect does it have on my policy? So today I want to show you just that. And I also want to take one step further and show you what would happen if you never paid your loan back. So the scenario here is my 36-year-old male client is funding his high cash value policy at $40,000 a year. In year 5, he wants to take out a $50,000 loan. In this first illustration, we're looking at he doesn't want to pay the interest. So basically he's borrowing the interest. Because what's going to happen is the interest is going to go onto his loan and it is going to compound each year. The amount of that interest is going to be added to the loan amount. So that's what's happening in this first little square, this first quadrant. The second one is if he did pay the interest. So if he pays the interest, matter of fact, in this one, he actually did not pay the interest year 1. So we took out a $50,000 loan. His balance was $52,850. But as you can see here, it remains $52,850 because each year he's paying that interest. Whereas where he's not paying the interest, you can see the loan amount increase from $55,000 to $65,000 by year 9. He's going to pay it off in year 10. So in year 10, we see the premium outlay. So instead of $40,000, he's paying $105,970 because he's paying that $65,000 off. His cash value in year 10 is $458,207. If we look at the plan that he paid the interest going along, he's going to pay back his loan amount again right here, $92,850, and his cash value is $458,42. So if you look at the difference between cash values of paying your loan interest or not paying your loan interest, it really is not that much different. We're looking at around $235 difference. So he has a little bit more in the cash value if he pays the interest, but not a considerable amount. How does that affect it even going further? Well, let's look at year 15. In year 15, his cash value has grown from $807. The loan is in the past. $807,525, and in year 15 of the one that he did pay interest, it's $807,830. So again, a couple of $100 more. Death benefit is $2.587739 compared to $2.587002. So whatever floats your boat as far as paying the interest, whether you do or not, it's really not going to make that much of a drastic difference. So I want to take this one step further, and let's look at if you never paid the loan back at all, because you don't have to if you don't want to. It's just going to stay off your death benefit. So this first one over here is no repayment, and this is the one where we borrowed the interest, meaning we did not pay interest every year. So again, we have our $50,000 loan. We're funding this. It's the same exact policy, except we're not paying it back. So as you can see, when you don't pay the interest back and that loan amount keeps growing and growing and growing, now over the long haul, it is going to have an impact on your policy. So if we look at year 20 of not paying it back to year 20 of paying it back, just having the interest, we're looking at a difference of cash value of $1.8 2 million, 1.203 to 1.133. So the difference is getting bigger as we go through the years. The cash value, even though those loans are not being paid back, the cash value is still increasing because the death benefit is still increasing because as your cash value increases, so does the death benefit. So in year 20, we're looking at a difference of $3,078,000 when he did not pay his interest, or 3.148 if he did pay interest. So again, not drastic, but as the years go by, it's going to start feeling, it's going to have an impact in the long term because it just keeps compounding. If the interest didn't compound every year, then it would be different. But for short-term loans, 5 years, 10 years, if you don't want to pay the interest, it really is not that big of a deal. So I hope this kind of just addressed something that maybe you weren't aware of. If you have any questions, please feel free to reach out to us. I'm going to turn this back to Steve. He's going to give you a quick little recap and some action steps, and we hope to hear from you soon.
Oh, thanks, Denise. Terrific example. Denise covered the flexibility and why, even if you don't pay back your policy loan, especially within a short period of years, maybe 5 years or so, it's not going to impact the cash value that much. It's one reason why this is such a flexible loan. The other thing is, if you don't pay it back at all, it comes out of the death benefit. These are terrific options for people to create tax-free liquidity. Denise did mention that if you wait for many, many years, 5+, that it could be some compounding negativity. So it is good to be an honest banker. I want to make that point before signing off. If you want to talk more with Denise about policy loans or anything having to do with high cash value life, there's going to be a calendar link below wherever you're watching. Go ahead and schedule. Also, comment and leave any questions you might have, and we will respond to the comments if you keep it classy. See you in the next one.